Sit down. Today's review is for the people who keep telling you they are the grown-ups in this industry. The ones in quarter-zip fleece at Sand Hill Road offices. The ones writing state of crypto reports with glossy charts. The Silicon Valley venture capital cartel that has spent 8 years convincing the world it is protecting crypto from itself while running the single largest exit liquidity operation in the history of the space. The two main characters today are a 16Z Crypto, the blockchain arm of Andreessen Horowitz run by Chris Dixon, and Paradigm, the firm founded by Coinbase and Sequoia alumni. There are others: Polychain, Multicoin, Pantera, Hound Ventures. But if you want to understand how the cartel works, you watch these two. Their sales pitch is simple and has been consistent since 2018. We back builders. We think long-term. We hold through cycles. We are the adults. The pitch is beautiful. Let me show you what the pitch looks like in practice. Specimen number 1. The narrative manufacturer. This is the partner whose job is to write multi-thousand-word essays about why the next thing is inevitable. In 2021, it was Web3 social. In 2022, it was the metaverse. In 2023, it was zero-knowledge everything. In 2024, it was AI agents. In 2026, it is stablecoin payments, prediction markets, and real-world assets. The list is not wrong. It is just a list of whatever the firm already bought. Specimen number 2. The unlock scheduler. This partner's real job is negotiating a tokenomic structure for portfolio companies where the VC's allocation unlocks right after public listing, but before the first major correction. If you have ever wondered why so many high-quality crypto projects launch at fully diluted valuations in the tens of billions, then crater 60 to 90% over the following 12 months, this man's spreadsheet is the answer. Specimen number 3. The we never sell early partner. This one is a thing of beauty. He goes on podcasts, looks the interviewer in the eye, and says his firm holds for the long term. Then his unlock schedule says something different. Then his public wallet shows something different. Then the next fundraise requires him to realize gains to show his limited partners a distribution. So he sells quietly into the liquidity his own marketing created, and the next podcast he appears on, he is still explaining why long-term conviction is the key differentiator. Specimen number 4. The Amicus Brief Warrior. This specimen is the firm's general counsel, writing legal filings defending innovation against SEC overreach, while simultaneously structuring his portfolio deals so they look exactly like the securities the SEC is complaining about. The public position is principled. The private position is please don't look at our cap tables. Specimen number 5. The fair launch mocker. This is the partner who publicly dismisses fair launch projects, things like Hyperliquid and a few others, as unserious, because a fair launch project by definition does not need a venture capital firm to exist. Fair launches are an existential threat to the business model, so they must be ridiculed in every appearance the partner makes. Notice he never ridicules them with math. He always ridicules them with tone. Now for the receipts, and these are all current, not old news, fresh. In March 2026, Fortune reported that a 16Z Crypto is raising its 5th dedicated crypto fund. The target size is $2 billion. 2 years ago, their fund was $4.5 billion. So the target for the new fund is less than half the size of the last one. The narrative from the firm is, we are taking advantage of a shorter cycle. The translation is, the limited partners we usually raise from are tired. Paradigm, the firm that raised a record $2.5 billion at the top of the 2021 cycle, is raising up to $1.5 billion for a new fund. And here is the interesting detail. The new fund is not a crypto fund anymore. It is a crypto-plus-AI-plus-robotics fund. That is a pivot. The biggest crypto venture firm by Cycle Peak Capital has quietly concluded that pure crypto is no longer a fundable thesis on its own and is merging its branding with whatever is currently hot. The total crypto market capitalization is down more than $2 trillion from its October 2025 peak of roughly $4.4 trillion. The firms that spent the entire cycle writing reports about how their portfolio companies were positioned for the inflection are now raising significantly smaller funds and quietly pivoting their thesis. These are the facts. These are in the Fortune article. These are not disputed. And the broader pattern of the last cycle, the one that tells you what smart money actually did with the money, is visible in any chart of the 2021 and 2022 token launches backed by these firms. The chart shows launch at a $50 billion fully diluted valuation. Unlock begins at month 6. Price drops 60 to 90% over the next 12 months. Retail exits at a loss. The VC walks away with a multiple return on the fraction of their allocation that they managed to sell into the chart before it fell. This is the business model. Here's the autopsy. Venture capital is not a bad business. I want to be clear about that. Funding early-stage technology is legitimately hard. It requires capital, and most funds lose money. The honest version of this business is a valuable thing. The problem is that crypto venture capital specifically was allowed to do something that traditional venture capital cannot. They were allowed to exit publicly at enormous valuations without the target company having revenue, users, product market fit, or a functioning product. The token listing became the exit. And the token listing was almost always structured so that the insiders could sell while the public could only buy. The venture part of venture capital disappeared. What was left was a very refined distribution channel for bags. The firms were not wrong that there would be a cycle. They were not wrong that crypto would matter. They were just wrong about their own role in it. They pretended to be partners. They were actually the source of the supply everyone was absorbing. Here is what you take with you. When a venture capital firm tells you they back builders, do 3 things. Check the cap table for unlocked dates. Check the token's fully diluted valuation on day 1. Check what % of circulating supply the firm holds at any given time. If the cap table shows heavy VC allocations with aggressive unlock schedules and a high FDV, the builder support narrative is marketing. The builders are the cover story. The unlock is the plot. And when a fair launch project outperforms a venture-backed one, which has been happening more and more often publicly in ways that cannot be dismissed, pay attention to who mocks it and who praises it. The mockers are telling you something about their incentives. They cannot afford for fair launches to work because fair launches do not need them. Their critique is not a critique. It is a job preservation exercise. The cartel is not going anywhere. There is too much money involved, and the limited partners who fund them still believe the pitch. But you, as someone watching this channel, do not have to keep being the retail bid that makes their exits possible. You can watch the cap table, not the podcast. You can watch the unlocks, not the essays. You can treat the glossy reports as the marketing they are. And you can save yourself a significant amount of money by remembering that smart money is a brand, not a behavior. This is not financial advice. This is experience. There is a difference.